Okay, super excited about today's video, guys. We are going to be looking at ticker symbol FCEL, fuel cell energy, and I'm going to show you guys one of the most slept on and, in my way, easiest ways of passive income and passive investing on a stock that you're bullish on. Okay, what you can do is you can purchase 100 shares or more minimum of that stock, and you can sell covered calls against it. I'll give you a little tutorial of that. Basically, you would come in here. You would pull up your option chain. You would go to the left side. These are the calls. These are the puts. And you would choose something that you're comfortable. Okay, so it says fuel cells at 739. Hey, in November, if fuel cell goes up to 10 bucks, I'm happy with that. I'll go ahead and I own 100 shares at $7. You know, that would be almost a 50% profit goal right there. Basically, if you own them at 7 and then you sell them at 10, you just sold your shares for 50%, right? Do you hear people all the time be like, man, I just got 50%? You don't hear that a lot. You see it from YouTubers and things like that, but do you actually know anybody that's doing that? Okay, I'm trying to teach you guys so that you guys can be the ones doing that. Okay, and you don't have to, watch these videos. You don't have to trade stocks every day. You could literally choose one stock, okay, and you can, if you own 100 shares or more, you can get paid for those shares, okay, by selling covered calls. And as long as the stock is below that price at the time of the expiration date of November 5th, 2021, I got to keep this money right here that I sold the contract for, okay? You would go here, sell single, okay? Change it to one for every 100 shares. If you own more, go right here, and you could get $14 for free just because you owned 100 shares and you have the leverage to, sell 100 shares at a strike price of $10. So if fuel cell is below $10 at November 5th, 2021, you just kept all that money, that $14, and you could have bought one or two extra shares. That cash it's cash. It gets deposited into your account immediately, and you can spend it or withdraw it. What I like to do is like to just kind of save up that money a little bit and buy some more shares when it comes back into my buy zone, okay, or a good support level or a good average down cost or average up cost basis. All right. Next strategy, okay, is you can sell puts. Okay. Now, when you sell a put, that means that you're basically legally obliged to buy 100 shares at a certain price. Okay, so for me personally, we in the Discord options trading tycoons, I've been going over this one a lot. Okay, and I have been saying that like basically from here to here is going to be our buy zone, and that we need to start loading up on some shares and dollar cost averaging. Okay, um, we're looking at the 1 hour chart right now. Anyways, if you got some shares here, I've been gathering up some shares. That's not the main point of this video. Okay, so what I wanted to say was fuel cell currently looks to be heading towards our second bullish price target of 829. All right. Um, if your average cost is like $6 on fuel cell, here's a strategy that you can do to either to get paid. So let's say a lot of times people will just go click buy and send, buy a share at whatever price. Okay. What I'm telling you guys is to be smarter than that. And instead of putting a limit order in for $6, what you can do is you can go and sell the $6 put on fuel cell. Okay. And then you can get credited this $13. Okay. And that $13 would go straight into your account. And as long as fuel cell is at $6 or below by November 5th, now you just bought 100 shares at $6. So you could have just, bought 100 shares at $6 whenever the stock hit that, or you and then the stock could drop lower, drop down to 5, okay? But this is a way to hedge yourself or protect yourself or get paid for wanting to purchase those shares, okay? So if let's say it drops down to $5 and you bought them at 6, okay? Well, now you're already down $100, basically, or whatever. Sorry, basically down $1 per share. All right, however many shares you got. If you had 100, that would be $100. That's why I said that. But if you sold a put, your loss wouldn't be 100; it would be 87. You would have lost 87. okay, because you gained $13. So that brings your total cost average down for each share lower. So eventually, if let's say you just only own 100 shares and you're selling covered calls and then you're selling cash secured puts, okay? So if you sell a put, you either need to have margin or the funds available to buy those 100 shares. That's why I said if you want to place a limit order for $6 a share on fuel cell, don't do that. What I recommend is sell a put on it, okay? And if you can sell a put with an extremely close expiration date, that has a high probability of being fulfilling and being in the money at the contract expiration. Those are good, okay? Or you can basically that's where I'm going with it, okay, guys, is there's two ways. If you own 100 shares, you can sell covered calls, okay, and make a little bit of money, all right, doing that. And if you do that consistently over time and the stock price keeps going higher, the contracts that you sell are going to be more valuable, okay? If fuel cell is trading at $12 a share, okay, the options contracts are going to be more expensive because the stock price is higher. So the next covered call you sell, you might be able to get 30, 40, $50. The next cash secured put you sell, you might be able to get 30, 40, $50. Okay. And if you've been doing that along the way and you brought you know, you've consistently been bringing the cost basis down, okay, then you can make your money. Okay, that's how you can make your money. And if you, let's say you have a long-term position and you've been holding this share for a year or two and you've made enough money off of selling options contracts on your against your shares, using your shares as collateral, that now you sold so much that your shares actually you've gotten paid just for owning your shares. So if you buy 100 shares at $7 and you've been selling cash secured puts, covered calls against it long enough to where you have got $700 in credit from it, then now your shares are free. Your shares are free. It didn't cost you anything. It initially costed you something, but you've made all that money back. You got it returned back to you. Okay. The next thing I want to go over is buying puts. Okay. So another way to do it, okay, is let's say you own 100 shares at $7, that's $700, and you think it might go down a little bit. Okay. We'll look at the chart here. Hey, we just hit our bullish price target. This thing might drop a little bit, let me go ahead and buy some puts. And when you buy a put, it means you think the option price is going to go down and you could trade it. Okay. We're not looking to hold these puts to expiration. We're looking to get in and get out and just make a little bit of money, okay, protecting ourselves because, hey, this thing, my shares are doing beautiful, man. I just bought this stock a month ago and they're up 20%. If you have a feeling that, hey, maybe your stock is overbought, buy a put on it, okay? And you can day trade that put and sell it for 20, 30, 40%, um, and make a little bit of money while the stock is going down. Okay. So, good example, we hit this bullish price target. Okay. Had some puts, came down, made a little bit of money. Okay. Made a little bit of money back. And if you look, it is really the best way to hedge your shares because look how cheap they are. Okay. Like $53 per contract or 60. So it's probably about 55 in between there. So like $55 out of your 700. If you have $700 and you've been selling cash secured puts, you've been selling covered calls, let's say you have $55 free now and you think that the stock is going to go down and you want to make a little bit of money while it goes down, but you're not betting on the stock to go down overall because you're bullish and this is a long-term hold. So you've got this great long-term hold. Maybe it ran up a little bit too quick. Okay. You're like, hey, this is probably going to have a pullback. Okay. Let me spend $50 out of my initial 700 investment. Okay. Let me put another 50 in there to protect myself. And oh, hey, you know what? That $50 turns into 60 or 70. And, and depending on how many options contracts you buy. Okay. I was just trying to give you guys an example of like doing, like 100 shares, one contract. Okay. But if you're super bullish or like you're super have strong conviction basically on your play and you're like, hey, I know that fuel cell is due for a pullback. So let me go ahead and load up on some puts real quick. And you may drop another 300, you may drop 500 on there. Okay. I like to keep it basically where it's like, for me personally, about 10%. Okay. If I want to go into some protective puts is what I call them, I try to use around 10% of whatever my investment in that stock is. Okay. Because I don't want to throw all my money into betting on the stock to go down when I'm looking at it at a long-term perspective for the stock to go up. Okay. So hope you guys learned something today. I hope that that made sense. The stock market is just one of the greatest things ever invented and can really change people's lives if they learn how to do it. So today we went over selling cash secured puts, okay, buying protective puts, and selling covered calls. Okay. Those three things right there, I think can change a lot of people's lives. And I think that you can be extremely successful picking blue chip stocks, for instance, like Apple. And if you can own 100 shares of Apple, if you have enough money for that, and you can sell cash secured puts and you can sell covered calls and you can buy protective puts against it, you don't need to be an active day trader to do this. Okay, you can do this. Just set some alerts on your phone, like, hey, this alert right here went off. This super bullish alert, and the name of that bullish alert was check out some puts. And then you go check out some puts, and all the puts are super cheap because the stock has blown up too quick. You can buy a couple of those and say, and then it pulls back, and you're like, all right, cool, nice. I made a little bit of money off that pullback. All right. And you don't have to be super active to do that. You can just click a couple clicks on the phone and sell your puts for a decent profit, 20, 30, 40%, something like that. Okay. Oh, thank you guys for watching. Don't forget to subscribe, like, comment. Let me know what you guys are trading. Do any of you guys use these strategies that I just told you about? Let me know down below.